Hi there everyone, and welcome along to the third micro lecture. This is micro lecture 3A on your UGB223 business finance module. The information I've taken today is drawn from the key publisher slides, and what I've done is I've taken the slides I feel that are most important, that are focusing on risk and return and also ordinary shares today. And these come directly from the core textbook, which is the McLeany text, Business Finance Theory and Practice. So if you've read chapter 8 of the core textbook, you're going to be in an excellent position to have the foundational knowledge, and hopefully I'll be able to put some commentary on top of the key slides that will help you to understand and get to grips with some of the core concepts associated with this week. So as I've discussed previously, the context of risk and return is extremely important throughout this module, and it's a theme that occurs throughout. And in the context of financing, it's extremely important when a business is thinking about which types of long-term finance it can feasibly use. So to a business, sources of finance that are cheap in terms of servicing costs, that would be debt-based financing such as loans or bonds. They tend to be quite cheap to service, because there's lower risk to an investor if they're investing in those forms of finance. But they tend to be quite risky from a business perspective, and this is really within the context that there's a legal and a contractual obligation to meet interest and redemption commitments. So if a business uses debt finance, it's got a legal obligation to meet interest payments on that debt. It can't just decide, I don't want to pay the interest anymore. Whilst those that are less risky, such as equities, which is in the form of things such as ordinary shares and preference shares, they tend to be quite expensive to service. And this draws up on things such as the creditor hierarchy, so where shares lie within that. And equity is higher to service, but there's no legal obligation or requirement to make dividend payments. So they're slightly less risky from a business perspective in that regards. There's not a legal obligation to make dividend payments, but they are expensive to service. To the provider of finance, on the other hand, risk and reward are positively linked. That is basically meaning high returns mean higher risk and vice versa. And this is in the context of the investor decision-making process. So if an investor is thinking about investing into ordinary shares, they fall at the bottom of the creditor hierarchy. They carry higher levels of risk. You might not get any dividend payments, for example. So the demand or the return that's expected is going to be higher. On the other hand, if an investor invests into bonds, there's a legal obligation to meet interest payments on bonds. So from an investor viewpoint, that will be classified as lower risk. So they're consequently going to demand lower returns if investing into debt-based finance in the form of things such as corporate bonds. And this just provides a fairly useful chart, I think, that starts to highlight risk and return relationships for various types of securities that businesses or governments can actually issue. Now, on the horizontal axes, we have risk, and on the vertical axes, we have expected and actual returns. So, as an absolute minimum to induce investment, investors are going to demand what is called the risk-free rate of return. And then as we progress along this purpley pink line, what we see is a range of different securities. We say short-dated UK government securities. Very low risk, very low expected rate of return. And that's predominantly due to the fact that it's highly unlikely, say, the UK government would default on making interest payments. As we move up this, the next thing we say are corporate loan notes, which are when businesses issue their own debt finance. So large corporations such as Microsoft, Vodafone, Barclays, Amazon, they issue their own debt finance to raise funds. But when they issue their own debt, again, there is a legal obligation to make interest payments associated with that debt. So once an investor provides finance, they face low levels of risk because they're pretty much guaranteed that they're going to get their returns unless the company goes into bankruptcy possibly. But obviously corporate loan notes carry slightly higher levels of risk than government issued securities. Then as we progress further, we see corporate preference shares. So again, this is a form of equity-based financing, but if the business does declare dividend payments, the preference shareholders get their dividends ahead of the ordinary shareholders. And I'm going to talk a bit about ordinary shares and preference shares a little bit later in micro lecture 3A and 3B. And then right at the top, we have what are called corporate equities or ordinary shares. So this is where this is basically the backbone of any listed organisation and the things that are regularly traded on stock markets. But an investor into ordinary shares has no guarantee that they're going to get a return, so there's a higher level of risk. Also, if a business goes into bankruptcy, corporate equities or ordinary shares are at the bottom of the credit hierarchy, so you may not get anything back if a business goes into liquidation or bankruptcy. So again, this is quite a useful chart to highlight some of the long-term sources of finances that business use, and also effectively shows the risk-return relationships. So over the course of the remainder of this micro lecture, I just want to talk to you a little bit about ordinary shares. And then in micro lecture 3B, we'll draw up on some other long-term sources of finance. So what are ordinary shares? They're basically the owners or the shareholders' stake in the business. And they're quite often referred to as the backbone of any listed business. And these are the things that are quite regularly traded on stock exchanges for PLCs. And they're the largest element of business financing. Much of it comes from retained profits. So if a business makes a profit, it has a choice. It can return some of those profits to the shareholders in the form of dividend payments, or alternatively, it can retain those profits in the business to fund future investment opportunities. But it is the equity or the ordinary shareholders that have a claim to these profits. So a lot of business financing revolves around retaining profits to use for future investment opportunities. They're very risky for the shareholders, but they're low risk to the business. And low risk to the business in the context that there's not a legal obligation to make dividend payments to shareholders. Whilst if we compare that to debt, there is a legal obligation to make interest payments on debt. But consequently, because they're risky to shareholders, investors into ordinary shares are going to demand high levels of return, which if an investor demands a high level of return, that consequently impacts upon the fact that it's expensive to service for the business, a high cost associated with it. There's typically no legal or contractual obligation on the business either to pay the dividends, which is what I've already briefly talked about, or to redeem the shares. So, for example, debt-based financing, when businesses issue their own debt, they might issue what are called 5-year bonds. So they're redeemed after 5 years, or 10-year bonds redeemed after 10 years. Ordinary shares generally last in perpetuity or forever, or until a business is wound up or put into liquidation or bankruptcy possibly. Another key important part is dividends are not tax deductible to the business, but are feasibly taxable in the hands of shareholders. But that's quite often dependent upon shareholders' tax position. So it depends on a variety of factors such as how much income, because dividends are classed as income to an investor. Now, based upon their individual tax position, they may well have to pay tax on dividend payments. And also, to a business, dividends are paid out of the bottom line figure after tax has been paid. So it's kind of like that profit for the year. that a business makes, dividends come out of that. And shares are quite easy for shareholders to liquidate if they're listed on a stock exchange. Otherwise, it could be very difficult. And it's a partial explanation as to why many companies seek listings on stock exchanges. And this starts to draw up on the Stock Exchange Act in what is called its secondary purpose, a meeting place where people can buy and sell shares, which is, again, if you think about large organisations that are listed on stock exchanges, an investor has more confidence if they can buy shares knowing that they can easily sell them. And now I just want to talk a little bit about how ordinary shares can be issued, the variety of different mechanisms that can be used. Now, one way in which a business can issue shares is something called an IPO, issued to the public. So, for example, Royal Mail 2013 conducted an IPO. Facebook conducted an IPO. This is when kind of a company grows to a certain point. It wants to obtain a listing on a stock exchange and it wants to sell its shares to the general public. So IPO stands for Initial Public Offering. These are relatively rare in the life of a typical business because obviously businesses don't seek stock exchange listings all the time. This is where they are initially offering their shares to the public. But the IPO premium is a significant cost to the business and can rise to up to 4% of funds raised, although there are economies of scale if they need to issue equity finance again in the future. But kind of just get to grips with here, it's an expensive, time-consuming process if a business decides to raise new funds by offering shares to the general public. Quite often what they can do is businesses can do something called a placing, and I've kind of put there, what is a placing? And placings are very important in the context of issuing shares. And really, what a placing is it's a placing of groups of shares. So it might be 10% of the shares of one company. And what they'll do is companies will look for what are called large institutional investors. And institutional investors are companies that buy blocks of shares. It's kind of a good way of putting it. Buy blocks of shares of differing companies. And what this usually does is because the ownership spread isn't quite so wide, it's kind of quite concentrated and quite narrow through placings. It means businesses can choose who they want to invest into them. And also it can be a little bit cheaper in the terms of issue costs as well. A very important aspect in the context of an IPO is pricing. And the question then starts to become, if a business is going to offer shares to the general public, and it hasn't done that previously, the question then becomes, what price does it issue those shares at? So again, Royal Mail had quite a bit of an issue in 2013 with trying to determine at what price they should be selling their shares because they'd never done it previously. And you start to get investment banks and brokers involved with these kind of things because a business is trying to sell all of its shares, ideally at the highest cost, but it doesn't want to sell them too high because then they might not sell all of the shares. So these are important aspects that need to be considered. And it is possible that a business might not necessarily always sell all of its shares or not always successful. So what it can do is it can underwrite or in effect use an insurer to ensure that all shares are sold. So this is kind of like, it's an insurance mechanism. If a business is conducting an IPO, it's not sure what price it should be selling its shares at. It's not 100% confident that all of the shares will be sold, i.e. implying it won't raise all the finance it requires. Then it can use an underwriter to guarantee that any shares that aren't bought will be bought by the underwriter. But again, there's a cost comes with this. So it's businesses weighing up these costs and benefits. rights. And what happens in the context of IPOs, control can feasibly shift from the original owners or shareholders to the new shareholders. In the context of IPOs, ownership tends to become very diluted and very widespread. And that's a consideration that needs to be made when IPOs are undertaken. And then another way in which a business can issue new ordinary shares is in the context of something called a rights issue. And this is something we're specifically going to be looking at in the context of the workshops this week. And basically what it is, it's an issue to existing shareholders at a discount on the current market value. And shares are offered pro rata to existing holdings. So what businesses, this kind of thought is, if you think about, if a business has already obtained a stock exchange listing, it's got quite a widespread ownership, and it decides it wants to raise some more cash or finance to fund a future investment opportunity. And it takes a decision that it wants to issue new shares to do that. There is a contractual and legal obligation that they have to ask the current or the existing shareholders first if they want to buy some new shares. And to entice them to do this, they offer them at a discount to the current market value. So that could be a 20% discount or a 30% discount. And shares are offered pro rata to existing shareholdings. In the context of this, issue costs aren't quite the same. They're a little bit less than IPOs. It might be approximately 3% of the funds raised. And in theory, the issue price isn't a big problem. So with regards to how much of a discount that the company offers to their existing share value. And this draws up on something called rights prices and theoretical ex-rights prices, and whether capital markets are indeed what are called efficient. Things we'll touch upon further. But the issue price will draw further upon within the context of the workshop activities this way. And if a business does decide to do a rights issue, they tend to be successful because investors quite often think, well, if we're buying shares at a discounted price, we're getting some form of bargain. But in theory, that doesn't necessarily pan out. And if all shareholders do participate in the rights issue, control stays in the same hands. So there's no dilution of ownership in the context of rights issues. On the other hand, rights can be sold by a shareholder who do not want to take them up. And again, this is something we're going to look at within the workshop, and we're going to think about the options available to an investor if a business is making a rights issue. And investors have three options. They can do nothing, they can sell the rights onto someone else to buy the share at the cheaper price or the discounted price, or alternatively they can participate in the rights issue. And we're going to think a little bit about how those elements would impact upon the wealth of shareholders. And then finally, rights issues seem to be losing their popularity in favour of placings. And I've kind of put there, why is this? Well, the main reason for this is placings, kind of businesses can choose who they want to invest into their companies. Because institutional investors buy blocks of shares. Also, it's probably cheaper or more cost effective. So again, there's one thing to get out of long-term financing strategy, there's not just one way. There's many different options available to business. And they have to think, right, we're trying to raise X amount of funds, and these are the options. What are the costs associated with the options? Should we issue ordinary shares? Should we conduct a rights issue? Should we try and place our shares with a company? Should we use debt-based financing? Should we use preference shares? And once we get into micro lecture 3B, I'm going to talk about these other options that are available to businesses in the context of long-term financing strategy. Okie doke, that concludes lecture 3A. I hope that you found some of this information useful, but if you do have any questions or queries, just feel free to get in touch. Thanks for listening. Cheers. Bye.